This is a stock analysis blitz for Concurrent Technologies. Please remember this is for entertainment purposes only. Concurrent Technologies make circuit boards, but 87% of their sales are in the defense sector, making them a de facto defense stock. When I did my initial defense stock filter, they didn't show up because they seem to be classified in the sector maps as a IT stock. And I have to say thank you to Nick Slinger, who provided a comment notifying me about CNC. They've actually been established since the mid 80s and have a presence in both the UK and the US. Most of their business are in circuit boards, which they call products, and these are essentially just circuit boards or plug-in cards, like you see here. According to their CEO, most of their business is where you have a defense company who wants to upgrade their product when a new chip comes out or something. And so Concurrent Technologies take on those projects just to put together a new updated board, essentially doing the same thing. They recently bought Philips Aerospace in order to set up a systems business. So here you've got more like complete modules rather than just circuit boards. And the company's aiming to grow through this systems business. They've got quite a distribution of revenues throughout the world, but the United States, the most important part. According to their CEO at the latest analyst call, they don't expect too many issues from tariffs because these kind of products tend to be exempt from tariff problems. We can see quite a rapid increase in order intake over the last 5 years. The net income, though, as you can see here, seems perhaps not quite so impressive. So I'll be taking a look at that in a moment. In terms of their balance sheet, just eyeballing this, and you see there's hardly any long-term debt. And in terms of short-term assets and liabilities, the company looks extremely healthy, with obviously loads more cash here coming in than going out in the short term. Looking at their profit and loss statement, and we do see a impressive increase in revenues. It's kind of doubled since 2021. And I guess the net income has kind of roughly doubled as well in this time. There's a couple of anomalies here that make it a little confusing. As you can see here, it's a little bit of a stutter step before things really take off. An excellent trend overall. What's muddied the waters a bit is that in 2019 they actually got a 1 million insurance payout, then kind of muddies the water when we look at the overall trends. And then in 2022 there were lots of supply chain issues which led to the funny results in that year. But yeah, it's undeniably a good trend and a healthy looking trend in terms of revenue and net income growth. In terms of assets, and all of their long-term assets are intangible assets, and a lot of these are investments they've made to build a new board design, which then gets amortized as they sell the product. Imagine it must leave the long-term assets and then end up as cash in current assets afterwards. In terms of long-term liabilities, there's nothing there. They have practically no debt. So this balance sheet looks very nice and clean. In terms of current assets and liabilities, you see that they've got loads of cash. They've got 14 million in cash. They've earmarked about 5 million to spend on this brand new purpose-built factory in Colchester. But obviously they've got plenty of money to pay for that. A pristine track record, really. Look at how they've just got all this cash sloshing around over a long period of time. Their current assets are mainly inventories and trade receivables. So stuff they're about to ship and money that's going to come in for stuff they've already shipped. And then when you look at the short-term liabilities, it's all trade payables. So when you compare that 9 million of trade payables with 19 million of inventories and trade receivables, this is an extremely healthy company when you judging by its balance sheet. And what you're seeing there is exactly what you'd expect to see if it's a company experiencing massive growth like this. So I've got here my market cap versus certain KPI. And it does look a bit like it might be on the pricey side, judging from this. We're racing ahead. You can see the market cap racing away from these other key metric here. I did my own rather crude valuation and found it to be a little bit, maybe 30% overvalued. I also asked Grok and also three different analysts, and also got numbers from three different analysts. Their numbers were all over the place. So, I mean, these are the experts, but the different experts seem to come up with completely different numbers. Generally, everyone's kind of points towards this company being overvalued. I listened to the latest analyst call for Concurrent Technologies, and I was very impressed with the management team and their whole kind of strategy going forward, etc. The books are completely pristine and we've got an excellent track record of growth here. Ultimately, though, it seems that the amazing progress of this company is priced in. I'm afraid we really kind of have to accept that when looking at this stock. So I'd say that they're best looked at as a high risk, high reward play. You're going in knowing they're kind of expensive because you're taking the risk that that's going to continue. But really, it would have been great to have gone in a couple of years ago. But at the current prices, I regard them as a high risk, high reward play. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.